Hey everyone, good morning. Citibank and Goldman Sachs have a couple of warnings that are going to be worth paying attention to. Obviously, I am going to give you a breakdown of these warnings, and give you my opinion on what it actually means. I will tell you what matters here and what doesn't. So let us get started. The first thing that I find very interesting, and I actually think this is an accurate concern to pay attention to, is the long end weakness. It gathers steam seemingly driven by a reconsideration of inflation risks amid sticky data and a stalemate on the US-Iran front. The USD is rallying as a result, which is something to note. The USD is pretty much flat year over year, so I wouldn't necessarily call it rallying, but it is coming up off of lower levels. What that typically means is when we have a strong dollar, companies selling goods outside of the United States face serious headwinds. When they bring those profits back for earnings, you could see that nasty FX impact. Companies will actually miss on earnings because of that foreign exchange pressure. A company like Apple sells a ton of product outside of the United States. Sometimes that stronger dollar can actually hurt their bottom line significantly. This is one of the reasons we have historically seen Donald Trump prefer a weaker dollar. It incentivizes international companies to buy from US companies, which is something to pay attention to. This is sort of an interesting note, but there are also some technical warnings here that you cannot ignore. They talk about Applied Materials having a significant earnings beat, but it did not drive a strong post-market rally. And this is a telling sign that indicates signs of tech fatigue are emerging. Sentiment indicators are flashing red, with overbought conditions flashing everywhere. Our sales trader is warning that we should officially trigger the oversold trigger. It just sounds like they are saying the same thing over and over again to scare you. And if we do trigger it, then we could see a painful sector rotation. And this was an interesting line from the report. They said software could be due a squeeze. I don't write like that, but they do. Software could be due a squeeze, but it is interesting to look at. I am not pointing that out because personally, I've been saying hardware rally since the beginning of April. We called it up front. And next is a software rally. So I kind of hope I am right because I want to be right on that prediction. Obviously, I'll take egg on my face if I am wrong that a software rally is coming, but I didn't purposefully pick this out just because of that. I just think it is interesting that they essentially saying something you can use as a tool. Look at what happened with Applied Materials. Could that be a little bit of a leading indicator that maybe tech is kind of at that extreme level? Now, are we due for a period of consolidation? It is also worth noting that the Citigroup IPO this week is really worth watching, because I think you had a lot of YOLO going and FOMO going into that IPO. And since it was priced at IPO, it has basically been straight down. I wouldn't be surprised if that keeps going down, especially since you need to look at the reality. Remember to watch my Citigroup IPO video where I break this whole thing down. The only reason they are gap profitable is because of a change in the valuation of warrants. Otherwise, this is a money-losing company. So they are literally going to go from screaming, look at all this money, to realizing they are losing millions. So that could create some major problems for that stock. And then, of course, that drags down the broader tech sector. Now, my thesis has been that the SpaceX IPO is really going to drive hardware spending because SpaceX is going to raise $80 billion. Honestly, they will probably raise like $100 billion. It will be like 2 times the Saudi Aramco IPO. Elon Musk has this obsession with comparing himself with Saudi Aramco for some reason. But what we are seeing is that now BlackRock is talking about investing billions of dollars into the SpaceX IPO. Whether they trying to secure an allocation right before the IPO or at IPO is not entirely clear. They are probably trying to get it right before the public access. But I think what is happening is you have a lot of institutions that are waking up. They're like, all right, we pretty much certain this puppy is going to get included in the indices. So we are either going to get our exposure later or we going to get our exposure up front. I am a little worried that things are getting a little overheated with the SpaceX IPO hype. But hey, I could see the enthusiasm. And I will say there's a massive shortage for actual hard data centers right now, which interestingly, SpaceX might be able to capitalize on. They could turn XAI into a profitable data center leasing company, essentially, given that massive deal they just struck with Anthropic, which is brilliant, absolutely brilliant strategy. And I think that was smart because really what we want is to see SpaceX succeed because it is really going to prop up the whole market. It props up the hardware market. And that money, I think, eventually transitions to the other lagging sectors, the finance stocks that are lagging, the software stocks that are lagging, and so on. Okay, so that SpaceX IPO, by the way, was also set for, I think, the second week of next month, which will be quite interesting. So we about a month away from that SpaceX IPO. Let's get back to some of these Wall Street notes. A test of Liberation Day highs on the 10 and 30-year Treasury yields is happening. Now, the 30-year breaking obviously 5%, and the 10-year yields breaking over about 4.6%. That 4.57 to 4.6 level. They say this could challenge the equity market rally. So obviously something else to pay attention to as we dealing with more information. Information coming out that basically shows nothing happened out of the China trade deal or the China visit, which I hate to say it. I didn't want to sound pessimistic, and I said this last week when people asked for my thoughts. People said, said, DD10, what do you think is going to happen with this China deal? I go, honestly, nothing. This China trip is going to happen and nothing's going to come of it. Because I personally think Xi Jinping has more leverage over the United States right now because the United States has kind of gotten itself into a quagmire with Iran. This morning, we heard that the United States demanded 5 things from Iran: give up uranium, no concessions on helping them rebuild, open the Strait of Hormuz, and, not support the Hezbollah militants in Lebanon, and the United States would only be willing to unfreeze less than 1/4 of Iranian assets seized, which is kind of exactly why Iran is like, F you. Like, what are you giving us if you are not going to give us our seized assets back? And we have to give up our uranium, and you are not going to help us rebuild, which are essentially clear conditions that they rejected from day one. Of course, we question how much bargaining power they actually have, which all comes down to control in the Strait of Hormuz. So clearly they have some leverage, especially now that there is talk that Iran is going to deploy deep sea subs in the Strait of Hormuz to make it even harder. We're not getting anywhere here. I mean, just this morning we had a UAE nuclear power plant hit by a drone. Now, fortunately, the nuclear facility itself wasn't hit. It was actually an electrical generator that was hit. And there were no injuries reported and associated with this attack, but it just shows you that there is a frustrating lack of progress with Iran. China kind of threw its hands up. We got fewer Boeing orders than we were hoping for. We didn't really get any kind of major announcement out of it. Oh, maybe we get FSD approval, or we get like an NVIDIA chip sale. Given that we haven't sold a single H200 to China, maybe we actually make some progress. Nothing. We got like a downsized Boeing deal that tanked Boeing stock, so very little progress in China. And I think it was really because Xi Jinping thinks he has got all the cards. In fact, Donald Trump has sanctions on Iranian tankers going to China that Chinese shipping companies that are extracting that oil are supposed to pay, and they let some of these ships through the Strait of Hormuz blockade to go to China, and they supposed to pay their tariffs. And Xi Jinping literally told those Chinese companies do not pay the tariffs. And Donald Trump's like, well, we're going to make a decision in the next coming days. We probably just undo that extra tariff. So in other words, we're going to paper hand on that as well, which is crazy. So let S go to the Goldman piece. The Goldman piece, which is interesting as well. Short note over here. So that was the Citi piece with some Iran commentary. The Goldman piece was the following. Oh yeah, here was a little note. Anthropic had agreed to $30 billion. Oh, that is okay. This is a new note here. Anthropic just raised money at a $900 billion valuation. They raised $30 billion, which is hard, cold cash. Cash that they could use to pay for data centers at SpaceX, making that XAI division profitable immediately, helps boost the SpaceX IPO, pumps that SpaceX IPO even more, which creates more of a wealth effect, a massive wealth effect for this full software AI cycle. It is all going to go to crap one day in the future, we know, but we just trying to watch for the early warning signs before everyone else. Rabobank had a really good piece on this where they breaking down the data. A lot of chip components like GPUs or some even server racks are booked out 26 to 52 weeks, so you can get some of the water cooling components that you need for months. Components needed for actually placing data centers in service are delayed for 26 to 52 weeks because a lot of this vital stuff is completely booked out. So really, if we want to see that turning point in data centers, we have to look ahead. Look at this cyclical spend of this next AI bubble or whatever we want to call it. We can look at the next 12-month out earnings and the forecasts, which so far they still holding up, so far all is still good in the numbers. Obviously, there is some reason to be nervous. Watch that Cerberus IPO. I think it is a little bit of a testing sort of warning ground for SpaceX as well. Though Cerberus, I think, is a kind of a pump and dump. Watch my full video on that before you lose your shirt. You can always join us as well over at my platform. We got a holiday coupon going on over there right now, and this is interesting. So Goldman says the following: there is a clear momentum chase that is being highly concentrated in everything AI, and what people are doing is they reselling their losers. They are buying winners on leverage. Leverage is accelerating, and then they rinse and repeat. And even though the tape still has bad breath, the market is officially getting away from people. It is getting away from a lot of the bears sitting on the sidelines, which is why I call this the most frustrating rally. The most frustrating rally since the beginning of April. We said it up front, people are going to be pissed. They going to be bearish on the sidelines. They going to miss the rally completely, and then they going to FOMO in at the absolute worst time. It is typically how it happens for the average retail trader. And even if you miss the hardware rally, that doesn't mean you should give up. That doesn't mean you shouldn't be looking for opportunities in software or other sides because, in my opinion, those sectors are next. There are great deals out there on amazing companies right now. Anyway, it is hard because when you look at the main index levels, it doesn't feel like it. It does feel like there are great deals. It feels like, everything is at the absolute top of the market. But that is just not true if you dig deeper. So what we do in our course member live streams, for example, is simple. Every day we pick a company, sometimes two, and we granularly go through them one at a time. And we look at the fundamentals and we is this a good deal right now or not? Or at what price is it a good deal. Like last October, we were looking at Robinhood at 160. We said, this is crazy. This is worth maybe 69 bucks at a fair price. Well, that is exactly where it sits today. So, sometimes talking about how something is too expensive can save you. It can actually save you a lot of money. But anyway, Goldman here says it is tempting to short, but Don T fight this move higher. In other words, Don T try to buy puts against this move higher. I actually agree with that advice. I think it is kind of dangerous to try to push puts right now. There is actually a whole Bank of America thing where they re-talking. I think this was in the Financial Times this morning where they re-talking about structuring creative put options to essentially help people reset higher. So that way you have a put for when the market does fall, but it resets higher with less of a loss. They just rolling your options is what I think is happening here to give you an option for downside protection, but without making you feel as bad that you are missing out on the rally. And to me, it is just a sign that the market makers want more of your money. The more options that exist, the more money they make, especially arcane and low-rated options. The more the market makers are making bank, they love this volatility and they love all this creative crap. Anyway, dips have been extremely shallow recently, and that is because the long-only community has been ready. They will continue to be ready to pounce as buyers on any red day. We are sitting at the worst market breadth since late 2022. Retail activity has inflected higher. Retail trading volumes have risen 28% since mid-April. Not a surprise that they were a little late to the party as usual. And the recent replacement of the pattern day trader rules helps. With less stringent margin requirements, it increases the likelihood of action. It increases the likelihood that retail trading activity will actually rise further, right? No more of that 25K limit holding people back. I am like 1 minute from finishing up my thoughts here. All right, so then people are coming out of their weekend plans, and we look at the tech exposure data. We've got infotech total exposure sitting at the highest levels. The highest tech exposures since January of 2024. Look at the data right now. We are at like all-time freaking highs on tech exposure. You see that right now in the charts. See, I kind of drew this little red line over here to show you crazy exposures right now in the market. And then among companies that have reported results, CapEx grew 38% during Q1 2026, while buybacks grew just 1%. Despite muted buyback growth, we continue to see execution. Very healthy, consistent executions on a corporate repurchase desk, but keep a close eye on this shift. In other words, if you actually look at like Meta and Google, things changed. Stock repurchases have plummeted because they re-spending it all on CapEx. The companies that are still repurchasing their own stock are software companies, but everybody else, like the hardware spenders, they not doing buybacks anymore. And that buyback volume is usually a big support for the market. And so when that support goes away, a lot of people wonder, okay, well, what happens next? When those employees that work there get their shares and then they sell them, they crack the egg because they want to go buy a boat or something stupid, then you only have downward pressure on the stock. So it is pretty common to see that when buybacks dry up, the market softens, the market starts getting a little softer. I think this market, I am still bullish on the overall economy. I know that there are underlying structural issues. We've talked about them regularly on this channel. None of this really affects my bull-bear scale drastically right now. I think the bottom line here is simple. Expect more volatility in the coming weeks. I think the Citigroup IPO is going down further. I think hardware, even if it takes a breather, still has legs. It has legs through at least the SpaceX IPO, maybe even a month after that. And then we're going to start transitioning probably in July or August. My crystal ball says towards some more software interest. So anyway, there you have a little update for us. Happy Sunday and good luck this week in the markets. We LL have a lot more hard-hitting content coming your way. If you are not getting all the notifications because YouTube is glitching, do this. Download my personal finance tracking app to stay updated. You can actually customize your preferences for notifications there. So you can say, look, I only want your stock and econ videos. I only want your Fed videos, and I don't care about the rest. That is totally fine. You can customize that completely. Now I got to go handle the rest of my day. I LL see you later.